Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, folks, to the Absolute Return Podcast. I'm your host, Julian Klimachko. I'm joined by my co-host, Mike Kesslering. And on today's show, we welcome special guests, Jared Kaplan, CEO of OppFi, and Kyle Cerminara, President of FG New America. OppFi, a leading financial technology platform that serves the everyday consumer, recently announced a merger with SPAC, FG New America Acquisition Corp, in a deal that valued the fintech company at $800 million. On the podcast, Jared and Kyle discuss the need that OppFi fills in the market and what sets it apart from traditional financial services companies, how OppFi utilizes artificial intelligence for its financial products, the thesis behind FG New America and why they chose OppFi as a merger partner, what sets OppFi apart from other fintechs in the market, and more. Point of disclosure, we are long FGNA shares in the Accelerate Arbitrage Fund ETF. So with no further ado, here's our conversation with Jared of OppFi and Kyle of FG New America. We are live with Jared from OppFi and Kyle from FG New America. Really excited to get into things today. Both you guys are in very interesting business lines, fintech, SPACs, all the good stuff. And you guys are currently merging the companies, bringing OppFi public in a big transaction, which we're going to get into the details later on the show. But prior to getting into that, we always like to give our listeners a sense of, your backgrounds, what you guys are all about, how you got into the businesses that you're currently in. So to kick things off, Jared, could you walk us through your background, career, and joining OppFi in 2015, and what exactly attracted you to that opportunity within OppFi, and how have things sort of evolved since then?
Yeah, for sure. So first of all, thank you for having us on. It's nice to talk to you rather than read your Twitter feed every morning as I start. So this is good. We're moving up in the world.
Yeah, glad you enjoy it.
Yeah, my career, I started Goldman. I was an analyst in their tech, media, and telecom group out of undergrad, and worked with some of the sexiest media and technology companies before moving on to investing. I joined a private investment firm called Accretive, and it was unique in that we tried to start businesses from the ground up rather than investing in going concerns. We would have a sectoral analysis, we'd do a bunch of work, and I like to say I focused on only the most boring industries there, but I recognized that those are sometimes ripe for the biggest opportunities of value creation, and actually became an expert in workers' compensation, which I always joke was not my lifelong dream. But it culminated in the founding of a insurance technology business called Insurion, which was the first online insurance brokerage for freelance businesses. At the time, the only people online looking for freelancers as it related to insurance were lawyers looking to defend claimants for various insurance issues. So we started that business. I actually went and joined the CEO we hired as his number 2 employee to build it out. And it was my first foray into operating. That's where I learned online acquisition and how you deliver exceptional profitability to balance sheet companies, how you build proprietary technology. We were the fastest growing insurance brokerage in property and casualty when the Schwartz family approached me, and it was a CEO gig. So I had to be the number 2 for 4 years, and it was ready to be the number 1. And I took the job because it goes back to my investing roots, which was we invested in ideas where we felt we could drive value creation for a customer above and beyond their next best alternative. That was certainly the case for Insurion, but for OppFi and what the Schwartz family, our founders, had stood up, it was clear. I mean, you had a marketplace here of 150 million consumers that lack savings. They have less than $1,000 of savings. Their opportunities for credit access are essentially nil when they have poor credit scores, less than 620 FICO scores. And the markets of last resort are really poor products, payday loans and auto title loans. So using the OppFi platform as a facilitator of credit access with much better products in the markets of last resort, and then with the greater vision and what we're building out now, which is the digital financial services destination for, we call it the everyday consumer. was a huge, enticing opportunity. Best decision I ever made, and it's been a heck of a lot of fun to get to this point, and we got a lot of work and a lot more fun in our future.
And now, a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate Arbitrage Fund, symbol ARB on the TSX, is the world's first SPAC-focused ETF with a diversified portfolio of SPAC and merger arbitrage opportunities in an easy-to-use, low-cost ETF. The Accelerate Arbitrage Fund ETF trades under the symbol ARB on the Toronto Stock Exchange. Find out more at accelerateshares.com.
Thank you for that, Jared. I was actually driving past a payday loan a store with my father this past weekend, and had made the comment that really looking forward to some changes within that industry. And so it'll be exciting to hear a little bit more about what OppFi does and to address some of that within the industry. But first, before that, Kyle, can you share a little bit about your background and kind of some of the founding principles behind the FG New acquisition platform that you've built?
Yeah, absolutely. And thanks again for having us on. As Jared mentioned, the FG New America team came together. I started my career back at T. Rowe Price as an investor, and have spent most of my career investing in financial services companies and fintech companies. Have at this point invested in several hundred financial services companies, one of which was actually Ameritrade. But the span of my career invested across consumer finance, banks, brokers, online brokers, exchanges, credit cards, and all kinds of different types of financial services companies. I started at T. Rowe Price. That's where I met the chairman of our SPAC back in 2001, Joe Moglia. Joe had just taken over as the CEO of TD Ameritrade when it was called Ameritrade back in 2001. And at the time, it was about a $700-800 million market cap company. I was a young and aspiring analyst at T. Rowe Price in the financial services sector, and ultimately we made a very large bet on Ameritrade, and we became their largest outside shareholder at T. Rowe Price. And over the next few years, developed a really strong bond with him. He articulated a really interesting strategy of consolidating the online brokerage industry and using the platform that they were building to really benefit from the scale of combining these platforms into one much larger company. And ultimately, over the next 19 years, he consolidated 11 of those online brokers and eventually sold the company to Charles Schwab in 2020 for over $20 billion. So it was one of the great success stories of my career. But during that time, I spent about 6 or 7 years at T. Rowe Price. Eventually left, was recruited to go work for Steve Cohen, who runs what's now called Point 72 Asset Management. Worked for Steve for 3 or 4 years during the financial crisis. Actually sat next to him for about 2 of those years during the financial crisis, and learned a tremendous amount about the capital markets and financial services from him. And then eventually left and was the sector head of financial services for a tiger cub called Highside Capital that had spun out of Maverick, about a $5 billion tiger cub. And then in 2012, I founded FG with Joe Moglia. And I was, at the point in my career where it was time to start my own company, and went to Joe and told him about what we were doing, and he wanted to be a part of it. Since then, we've grown significantly. We've invested in dozens of companies, and we have now done our first SPAC, FG New America.
So prior to getting into this, OppFi and looking at the underlying business model, how things function, and the SPAC deal, I wanted to touch on this FG New America SPAC platform that you've been building, Kyle. And is this exclusively fintech focused? You're obviously a specialist in financial services. Are you looking to expand outside of fintech with respect to subsequent SPACs, or what's your underlying thesis behind the SPAC platform?
So we're building a SPAC platform under FG Financial Group that trades on the NASDAQ under FGF. Larry Sweat is the CEO of our SPAC platform. He's also the CEO of FG New America Acquisition Corp. And, Larry has a long experience of being both an investor and operator of SPACs. This is his third SPAC, but he's advised on a number of other SPACs and invested in hundreds of SPACs over the course of his career. And, we came together and decided that we would have both fintech-focused SPACs, so the Joe Moglia focused SPACs, the FG New America Acquisition, FGNA, and potentially future ones beyond that. And then outside of that, we have what we call our partner SPACs. So you probably saw Aldel Financial, ticker ADF, which was done with Rob Kaufman, who was one of the first founders of Fortress. That IPO'd in April of 2021. And that is not exclusively focused on fintech. And we have a number of other people similar to Rob, with really strong backgrounds that would like to do partner SPACs with us, where our team and at FG Financial provides the sort of the operations and back office and a lot of the due diligence and other aspects of it, of the SPAC process, given our knowledge of the SPAC process, and let somebody like Rob Kaufman, sort of who doesn't have as much experience in SPACs, go out and find the right deal for him, and then benefit from the platform. So we have partner SPACs, and then we also have the fintech focused SPACs in the FG New America platform.
Right. So Jared, when I was doing my research into OppFi, I noticed that one of the main kind of driving factors behind the business is the fact that nearly 60 million consumers lack access to mainstream financial products, which is just pretty shocking to me in 2021 when basically everyone has a high-tech mobile device. I was wondering, how does OppFi come along and fill this need for basically unbanked consumers?
The crown jewel of the platform is the credit decisioning technology.
Okay.
And it has been built with a very large data set. At this point, we have over 7 billion data points in the credit decisioning algorithms. That encompasses over 15 million repayment events. We've facilitated over 1.7 million of loans. And the idea is that the traditional world uses FICO and mainstream credit scoring to determine someone's creditworthiness. And for the majority of the country, and specifically this set, it's not a great indicator of creditworthiness. And alternative data can be very powerful to figuring out who's got both the ability and the willingness to repay, despite what their credit score may show. And so that is what the platform has been built on. We power banks, so banks hire us to acquire, to underwrite, and to service this customer on their behalf. And it's all done with the alternative data. And we also do something really cool in the beginning of the process, which is we actually try to go get them mainstream credit first. So someone applies and we'll ask them, hey, would you like us to go and do a diligent search on your behalf? Of course, the vast majority of people say yes. And then we will go to 20, what we call near prime platforms to see if they've got an appetite for the product. And we're successful 1% of the time of giving the business away,
right?
Which is pathetic, but it just proves the point, which is, hey, there's a long way we've got to go. There's a massive space. There's a lot of consumers. It's not low-income consumers either, right? This is your median U.S. consumer. They're making 50 grand. They got a job. They got a bank account. They just have a poor credit score. Right. And we're here because of the macro landscape. You've got wages which have been flat for decades. And you've got, even though inflation has increased wages here in the short term, all of the major costs of living, housing and healthcare and childcare and education had been increasing at a faster pace. And so, people making median wages just can't save. And if your car breaks down or something unexpected medically happens to you and you can't get credit access, you're in a really difficult situation. That's why I always tell people, don't believe a word I say. Go and see what the customers say, right? They tell the story better than I ever could. So if you go to Google or the Better Business Bureau or LendingTree or Trustpilot and just read the reviews, you will understand the reality of this country, why these products are crucial, but they must be structured in the right way. And when we talk about the platform that we're building, it's not just about the access part up front. That's critically important. People love us because they got laughed out of their bank And we said yes with our bank partners. But beyond that, once they've proven their creditworthiness, it's the right thing to do to graduate them back to more mainstream products. That's why we're launching the OppFi credit card here shortly. And then longer term, can we help them build savings and build wealth? And having Joe on the team, not only can we defend against the spread offense a little bit better than we ever could before, given his football acumen, but his business leadership is tremendous. And clearly his understanding of investment platforms, I think, may really help us down the line. Not tomorrow, not the next day. I mean, this is a longer, decade-long vision, but that's what we're trying to do for this customer.
Now, with respect to OppFi's business model, the lending platform, how do you guys generate revenue and profit? Are you taking the credit risk? Or are you basically just a loan sourcing platform for banks?
So after banks hire us to do the acquisition, the underwriting, the servicing, after they originate the loan, we will typically buy back about 95% of the economics of that loan. And then we have made the decision to hold the vast majority of that on balance sheet to build the business rather than sell it to third parties, although there's quite a robust market to do so. The thought being there is we wanted to maximize unit economics. You make about double the money by holding the economics versus selling it. These assets are relatively short-term in duration. They're 4.5 months. And we really believe in what we're doing. And whether you hold it or you sell it, it's the credit risk, which is important, right? Because if you sell it and the credit risk doesn't perform, people don't buy it anymore. So we're very comfortable with that model historically with the products. As we move into some of the longer duration products, we will look to sell some more of these to third parties, but that's how we've generated the economics of the business, and it's allowed us to build it without equity. Right. So the Schwartz family put in $12.5 million before we got there, but since November 2015 when I joined, we haven't raised $1 of equity to build the platform. Now, when we get out to the SPAC world and we're telling the story to institutional investors, we're like, who are you guys? We've never heard of you. And I'm like, well, sorry, we've been gap netting and profitable since 2015, and we didn't play it when we don't need the money. It's like, it's counterintuitive. We thought we were geniuses, and the Schwartz family were terrific in Todd Schwartz, our founder, just like very supportive and like almost a Buffett-esque mentality to building a business, like grow it fast, but only grow it as fast as you can drive profit. And that's how you build a real sustainable business. So we're enjoying the process of educating the institutional investor world on who we are and how we got here in what is typically thought of a capital intensive business. We've been able to make it incredibly efficient by building the delivery model with the banks the right way.
And that's a funny notion that you mentioned, somewhat ironic in that the most high profile startups or new firms are the ones that raise the most amount of money. And it's the ones that are solidly profitable and not bragging how much money that they're raising at these astronomical valuations. Those are the ones flying under the radar. And the thing that I like about the business model is in terms of your underwriting, you're effectively eating your own cooking, such that you would definitely have conviction in the technology and in the loans that you're making. So speaking of that technology, I noticed that you utilize quite a bit of AI, artificial intelligence, in the process. Would you mind describing how that works?
Well, if you're fintech and you don't say AI, machine learning, blockchain, and crypto, like what are you these days? Right?
Exactly.
No, we are heavily involved in what I'd put our AI and machine learning against anyone. The idea is to, on the AI side, automate what we can to make the process as frictionless for the customer as possible. So when a customer wants to go straight through, the technology works in such a way where the banks can approve the right customers and customers can get through the process quite seamlessly. We have gone from 0% automation there to, at the end of the first quarter, we publicly disclosed 40% of the approvals are automated. We'll get to 60% by the end of the year. And that's just continuously improving the technology to be able to do more of that. And we haven't lost the ability to do business the old-fashioned way as well. I mean, the other thing I love to tell people about is we've got the phone number on the website. Like, find a fintech company that puts your phone number on the website. And for the smaller percentage of people that want to reach out and touch the business, the number one question we get on the phone is, are you a real business? And we pick it up in just 16 seconds and we tell you what a great business we're building. So that adds to the customer service quality, the customer reviews. That makes it easier for others to go straight through because it builds trust and credibility. So that's a bit of our secret sauce. The machine learning side, this is the idea that as the data set grows from the decisioning technology, we're able to expand the approval box upon the bank's approval. We're able to expand that decisioning engine so that more customers can get access at same loss rates, right? We're not looking to necessarily drive down loss rates. We are looking to approve more people at the same loss rates. And that allows us to begin the journey, right, which is to get people access day one that is much better than their other alternatives out there. So we're constantly looking at that. We're prudent about how the machine learning works. It's not done in a vacuum. I think the other part of our success is we've been really thoughtful about growth and making sure the vintage is not one vintage is much larger than the other. You don't want to introduce a bunch of new variables that can turn you upside down pretty quickly. So we're very thoughtful about testing and then updating, and it's a continuous process that we've seen a lot of success. Early on, I think we approved like 4% of the new applications. Today, the banks are approving 10% of the new applications. So that means we still suck, but we got a lot better than we were early on, and we got a lot more room to improve in the future. So that's how that works, and it is the core lever of the business that has made us successful.
In terms of the opportunity set, the total addressable market, it appears that you found this huge niche, very profitable niche that you guys have certainly capitalized on. I was wondering what separates and what sets OppFi apart from traditional lenders, banks, and why haven't they capitalized on this hole in the market?
Well, banks, I saw this in insurance too. The big insurance carriers, the big banks, they have become wedded to the historical ways of thinking about risk, and it's really hard to change when you're that big. In this world, in the OppFi world, having confidence in alternative data to drive creditworthiness is a challenge for a lot of the bigger banks, and they're still relying on FICO. Half of our customers are at the largest banks.
Right.
They're at the top 8 banks, 50% of the customers. But when their car breaks down, they go to get a car repair loan, they're laughed out of the bank. I mean, they won't touch them. So that ability to understand which alternative data drives predictability has been critical to the model. I would say I also believe like whoever wins cost of acquisition here wins the space long term, in addition to the data set. So our acquisition model is turned upside down from traditional platforms. Most people are relying on direct mail. 80% of their business is direct mail. And I actually wanted to shut off direct mail when I first joined, and the founder said, yeah, you may want to take a look at the numbers. And it works really well, but the problem is anyone can mail the mailbox. So we lead with search engine optimization and email marketing and customer referrals. And then we've built deep relationships with 50 plus marketing partners where we've got a proprietary API that's able to optimize business based on a number of variables so that we don't waste their time and they don't waste our time. And we've built tremendous market share on those platforms, like the lending trees and the credit karmas, but also with near prime platforms that don't have an appetite for this business and other third-party sites that serve this customer and wanted a lending option. So that's a big differentiator. And then I would say the third piece is this, and it's a bit more qualitative, but it's quantitative in the reviews, right? These outstanding 4.8, 4.9 out of 5-star reviews across the board help us drive the whole thing. Our office is in downtown Chicago. Pre-pandemic, we used to have a lot of pride. People would walk into the office. You've got like 100 flat screen TVs. We're tracking everything in real time. And people will say, well, how do you kind of have this office in downtown Chicago? You've got like people that will answer the phones. You're saying you're high tech, and like for us, it's not mutually exclusive. It's all of that, which allows you to build a great place to work. You have happy employees. They deliver great customer service. Customers who are happy leave you great reviews. That converts more customers that don't talk to anyone. And the whole end-to-end funnel there has worked out very, very well by building it that way.
Now, from an investor's perspective, what are some of the risks that we should be aware of? Traditional with lending, there's credit risk, fraud risk. Where's the downside here?
Key risk of our business is regulatory.
Right.
In the niche of the space that we're in, we're very aware of it. We spend a lot of time on it. The best way to de-risk regulatory risk is to diversify the products that we've recently launched here. We've got a product called Salary Tap, which looks very similar to our legacy installment loan product. We call that product OppLoans, but the Salary Tap product is an installment loan that's repaid through payroll deduction. Right. And there's a really cool payroll deduction technology that's getting developed these days, and so we're first movers there, and it means a customer will agree to send us a portion of their direct deposit to repay the loan. So those products are much lower cost, so that helps. The OppFi card, we're super excited about the OppFi card. That launches in the second half of this year. That's will be considered mainstream. It's a mainstream credit card product, so that helps. And then actually going public was a big part of thinking about how to go public and why to go public was the amplification of the story and the platform. We've got the data, right? We try to give the business away every single day, and we can't do it. And that just shows the dearth of access. But the access has got to be connected to protection guardrails. Consumers need to be treated in the right way. And we have lots of thoughts about what legislation and regulation should look like in the space, but we think it should be in the form of access plus guardrails, not supply constraints, because supply constraints don't do anything about demand. And you have too many people that need access. And without products like this, you're left to markets of last resort. You're left to the tribal markets. You're left to the unregulated markets. So we spend a lot of time and energy meeting with members of Congress, regulators. We're big fans of the CFPB's small dollar rule that's been hanging out there forever. We think they should put that in place. And I'm hopeful that when we get on earnings calls and talk about our social impact story, talk about our success in graduating customers to more mainstream products, showing them that there's a real sustainable, positive way of doing this, I think we'll end up in a really great space. And we've got legislation called the Small Dollar Loan Act that we're starting to educate people on, which would look like the Credit Card Act for credit cards, but for small dollar loans. And I think, like any industry, whether it's Uber or Airbnb or any of the great big industries that have developed, there's always this regulatory precipice that you're on. And we think we have the data, the story, and the customers to get to the right answer here. And if we're successful there, we're going to build a massive, massive platform. And that's what we're set up to do.
And now a word from our sponsor, Accelerate, one of Canada's most innovative and fastest growing alternative investment solution providers, with a suite of institutional caliber alternative ETFs for investors seeking diversification and long-term performance. The Accelerate One Choice Alternative Portfolio ETF, symbol 1C, ONEC on the TSX, is Canada's first alternatives portfolio solution, providing exposure to 6 alternative asset classes, 10 alternative strategies in one easy-to-use, one choice ETF that charges a management fee of just 0.2%. The Accelerate One Choice Alternative Portfolio ETF trades under the symbol 1C, ONEC on the Toronto Stock Exchange. Find out more at accelerateshares.com.
So when you look at improving your unit economics moving forward, when looking at kind of the illustration of your unit economics, you have the largest cost is your net write-offs. And what you described earlier is that you're looking to target a loss rate. And so my initial thinking was, moving forward, you'd look to refine the credit decision-making algorithms to improve that write-off portion. But if you're targeting the write-off portion or to improve that, are you really looking then to just find additional areas of revenue and cross-selling to improve that top line, as opposed to just trying to slash costs on a scalable basis?
Yeah, our unit economics are incredibly strong today. That's what's driven the cash flow and the ability to fund it with ourselves, right? With cash flow from operations and from debt capital. There are some leverage in the cost of capital that we can drive down further. There's some leverage across the servicing platform on the cost of acquisition. But we actually look at it like we want to extend lifetime value. Today, the customer's with us about 11 months on average. And if we're able to graduate them to the OppFi card and then wrap around mobile banking and then ultimately investing and maybe get them their first mortgage, right? You've now built what SoFi has built for the Henrys. You've built it for the everyday consumer. And we're not looking to drive unit economics higher. I think, if anything, we're looking not to be greedy and to work with the banks to continue to make the products more and more affordable. Like, we've been very, very successful the last couple of years. We got the banks to waive all the late fees, get rid of the NSF fees, start rewarding the borrowers who are refinancing. Like, there's a lot more we can do there as we get bigger and we get more scale. So I think when you look at our projections, we've kept the margins flat. Actually, they're down a little bit. And that's the combination of continually getting back to the customer and then graduating them to more mainstream, lower margin products. It's a big space, and that will bode very, very well for building the company we want to build for the next 5-10 years.
And it makes sense. If you have the customer acquisition into your ecosystem, then it's only logical to develop that flywheel to offer additional financial products, such that you have synergies.
Especially if they love you, right?
Yeah.
If they love you because you were. I mean, if this is a person who's frustrated, right?
Yeah.
They can't get access, and they almost have the point of view of, you actually saw me for my true self. You ignored this score that everyone tells me is such a bad thing, and that creates gratefulness and loyalty. And so that's why we're very focused on building out the product suite because it's reversed from, you look at the neobanks, right? So the neobanks have led with user experience. They've led with early wage access. They've led with waiving overdraft fees, maybe spotting you a couple $100. We've led with $1,500 installment loans, right? And that is what is highly differentiated and unique. And so as an access play and then wrapping around these other more traditional banking services, I think we can build this digital financial services destination for this everyday consumer. And that's what's the exciting vision here.
Yeah, and another thing that's super exciting is a recently announced going public transaction. OppFi recently announcing a merger with FG New America acquisition, bringing the company public at a $900 million enterprise value. You mentioned the goal in going public, one of them being amplification of the story. What else are you seeking to accomplish as you transition from private co to public co?
It was a long process to decide how to get public, if we should get public. We looked at a traditional offering. We saw a lot of SPAC interest as a fast-growing fintech company that was profitable. We ultimately made the decision to go the SPAC route because of FG. We thought they were the right partner. Joe and Kyle and the team there, they have deep backgrounds in public market investing. Have been very helpful through the process. We also thought the SPAC process gives you the opportunity to really talk about the vision. I also thought it was going to be the most expeditious route. I think what's unique about the SPAC process versus a traditional IPO is you announce it and it takes you 6 months to get it closed. Whereas a traditional IPO, you announce and you're on the road, and 2 weeks later you've got the deal closed. So that was something I probably didn't anticipate. And it creates a little bit of an overhang just going through that process. But it has been relatively seamless. I think we were pretty well set up. Our financials had been previously blessed with PCOB and some of the hardest hills to climb as you're going public. That doesn't mean we haven't had to build some infrastructure and beef teams and making sure that we have what you need to have to be a public company. But I got a great team, like a fantastic team, and they're ready to go. And it will change the business going forward. Like it should be vastly for the better, and having a more amplified voice in a platform with a great partner like FG. We're excited to get this deal closed and then put our heads down and go execute. That's what we did in the debt capital markets. The first debt facilities we had were quite, I should say, unoptimized, and people didn't know who we were. And then we just basically did everything we ever told our debt capital providers, and they've rewarded us in spades, and we have fantastic relationships there, and we're going to do the same thing on the equity side.
It's always great to have both the private company that's going public along with the SPAC sponsor on the same podcast, because we get to get feedback and insights from both sides of the table. Now, Jared, you mentioned what appealed to you with respect to FG New America. Now, Kyle, I'd like to know what stood out about OppFi in selecting the company as FG's merger partner.
We had a good idea of what we were looking for, and we found all of it in OppFi. OppFi is a very profitable company. It's rapidly growing. We found a company where we could invest in it at a very reasonable valuation. So we think that the valuation is reasonable for as fast as it's growing. It's a profitable company. We think that there is a very obvious to us, clear pathway to multiple expansion. So valuation expansion with the development of the OppFi platform. So if this was just let's go build OppLoans as a monoline lending business, we think that we paid a very reasonable valuation for it, but it wouldn't have interested us as much as building the OppFi platform. So we think that as we build out the OppFi platform and diversify into what we think will be a lending, saving, and investing platform that'll look a lot more like SoFi over the next few years, we think that the valuation is going to look a lot different. We'll get significant multiple expansion than if it was just a monoline lending business. We love the management team. We think very highly of Jared. We think he's going to be an incredible public company CEO. We think the team that he's built around him is great. We think our team's going to be, if you look at the skill set of our team and what they're trying to build, we think it's a perfect fit to build a lending, saving, and investing platform. I mean, I can't think of someone that should have more credibility in building a platform like SoFi than Joe Moglia, the guy that built TD Ameritrade over the last 20 years.
And Kyle, as a sponsor, what part of the SPAC process differed most from your expectations going into this process? either positively or negatively.
In terms of, maybe could you clarify that question?
Yeah, so basically expectations as a sponsor starting in when you're launching the SPAC, you're not through the entire transaction yet, but was there anything that you found either very positive that was unexpected when looking at companies and whatnot as you pursued the transaction, or on the other side, on the negative side, that was a little bit unexpected?
Well, I think when we the SPAC market has evolved over the last few years. I think that SPAC sponsors like ourselves, with someone like Joe Mugway, who has a tremendous amount of experience as an operator, with people like Larry and I who have great experience on the investing side, I think we make for very credible SPAC sponsors. I think that a lot of SPAC sponsors, and there's a lot of other great SPAC sponsors out there right now as well. I think that the SPAC market has evolved, and there's just a lot of people that have come into the SPAC market, which I think is great because it's really made it a viable alternative to the IPO process. At the same time, I think that maybe the market got a little overheated 6 to 9 months ago, and there was just a lot of SPAC IPOs and a lot of money flowing into some SPACs that maybe shouldn't have received capital. As we went through the process for identifying a target, I think that one thing that we found to be interesting was some of the valuations that some of the companies that did announce targets. We thought that they went for higher valuations than we would have paid. I think we paid a very reasonable valuation for OppFi. In fact, I think that I'm surprised that we think that the market will react very favorably to this, when the transaction closes. So that's probably been our biggest surprise, is just how much the market has developed. How many people are in the market, and the quality of companies that are now pursuing a SPAC today versus perhaps 2 years ago.
Now, to touch on the market reaction, what the market thinks of the story, if you were to give a 60-second elevator pitch to a bunch of investors on why they should pay attention to OppFi as an investment, you mentioned other high-profile, fintech companies recently going public or that went public, SoFi, etc. Why should they pay attention to OppFi, and why do you think that the street should notice it and be excited about it?
Yeah, as I mentioned, I think you've got a very profitable, rapidly growing company trading at a very reasonable valuation that has historically been in a monoline lending business that's evolving into more of an OppFi, SoFi-like, diversified platform that I think is going to be, lead to much higher multiple expansion over time. Even if you look at the comps, the publicly traded comps that are relative to its existing business, I think that the valuation upside is very significant. And then as we execute on, the transition to the broader lending, saving, and investing platform over the next few years, I think you're going to see dramatic multiple expansion. I think the management team here, I've found that when you invest in great management teams, you often do well. I think Jared has built a great team around him. I think he's going to make for a great public company CEO, as I already mentioned. And I think having our team behind them and Joe Muglia behind him is going to be very helpful to them as a public company. So I see this as a really interesting public company, and I'm really glad that we own a lot of stock, and I think we'll be involved in it for a long time.
And to the extent that other investors want to get involved, currently trading under the symbol FGNA, and once the deal completes, new symbol will be OPFI for OppFi. So Jared and Kyle, I want to thank you for coming on the show today, provided some very key insights into the underlying business model of both OppFi, FG New America, and key aspects of the going public transaction, which is super interesting and great details for investors and potential investors to know about the story. So thank you for sharing, and wish you guys the best of luck as you pursue this new opportunity.
Thank you for having us on.
Thank you.
All right, cheers.
Appreciate it.
Bye, everybody.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.